Welcome back to All Things Money. My name's David Blain, and during today's show we are talking a little bit about the stock market volatility. As you may have noticed, the past week or so, the volatility has picked up to the downside. The market, as I came to the studio to record this, was off about 2%. And we're discussing things that you should be aware of. I would not be overly concerned about this current downturn. As always, we like to take the long-term view. We think that the markets are still in a cyclical bull market. The United States is still in a secular bear, meaning multi-year period of low returns. But around the world, there are countries and regions that are definitely in bull markets. So we would not expect this near-term volatility and decline to turn into much. In fact, we think that we're poised for a good year-end rally and on into 2011. As always, if you have any questions or comments on the show, we'd love to hear your ideas. Our phone number is 252-633-0107. Our email is allthingsmoney@dlblain.com. And if you're next to your computer, go ahead and type in www.dlblain.com. There you'll find information on my firm as well as myself and the other professionals that work with me. There's also a section on the radio show where you'll find archived copies of the show, so check us out. We were talking about before the break the increase, the potential for decline in the market and what to look for. So we're focusing on there's indicators called the VIX, which is a volatility index that you can track the volatility of the markets. And we look for the volatility trends to rise, so pay attention to the VIX as you see the volatility rising. Typically, when markets are going up, as they have been, the volatility typically recedes. It's a pretty consistent procession forward. When market volatility picks up is when you start to see these wide swings of back and forth, down 2% one day, up 2% the next day. One of the other things that we look for is the index relative strength. We look for the higher beta indexes to start underperforming, such as small caps, the NASDAQ, lower quality indexes, the emerging markets. During downturns, we see these more volatile asset classes start to decline at a more rapid pace than, say, consumer staples or larger company indexes. In fact, Ned Davis Research, one of the companies that we use and they help with our research, they have what's called the SHUT Index, which is the staples, healthcare, utilities, and telecom sectors, and those are generally considered the four most conservative sectors. And so we watch those sectors, and if their performance, if they start to outperform the market as a whole, it means that to beware of a correction is imminent. The same thing with industry relative strength, where we take an aggregate of the relative strength, and we see that over 82% are in a positive mode. If we start to see that fall off, we'll be in the midst of a correction. And all these indicators are starting to indicate that we are, in fact, in a period. It wouldn't surprise me if we had a good 3 to 5%, maybe 7% decline in the market over the next few weeks. We also see stocks and markets start to drop below their moving averages and things like that. Now, having said that, as I've mentioned several times previously, as well as several times today already, we do, after this near-term weakness, we do expect that strength through the year end and into the next year. Although as 2011 progresses, we think that there will be some other risks that are going to emerge. But for the, say, six-month time period, we do think that it's going to be relatively positive. I wanted to spend a minute or two on a technical indicator. We at our firm, we look a lot at fundamentals of companies, we look at trends of companies, we look at valuation, we look at sentiment. Now, on the aspect of trends, there is a body of stock analysis called technical analysis. We feel that trend analysis is more of a fundamental type, getting a feel for the market, where pure technical analysis is just looking at, say, charts and graphs and things like that. Well, one of the more prominent technical indicators that a lot of people look for, it's also a trend indicator, it's sort of a hybrid, is when you look at a market index, their 200-day moving average, basically the average price over the past 200 days. Or you can look at shorter term moving average, such as the 50-day moving average. Well, in the investment industry, there's something that's called a golden cross. And the golden cross is when the 50-day moving average of an index, say the S&P 500, crosses above its longer term moving average, the 200-day moving average. And what this is an indicator of is it shows that the market has short-term strengths that is actually exceeding its long-term strength. So anyway, the golden cross, 50-day moving average, crosses above the 200-day moving average. It gives you a good indication of, especially if they're both in uptrends, it gives you an indication of relatively strong short-term strengths. And we had Ned Davis take a look at this and crunch some numbers on the effectiveness of following that strategy. However, I'm going to make you wait until after this commercial break before I give you the results of that test. So when we come back, we'll continue our discussion about the 50-day and 200-day moving average and if it's worthwhile to follow. For All Things Money, my name is David Blain, and we'll be right back.